Well, good morning, everyone. Very nice to be together for what I hope will be very stimulating 30 minutes of, no, 40 minutes it looks like we've got. Terrific. We're going to need every minute of that. Discussion on the relationship between investors and companies and the role that investors can play in enabling companies to embrace those transformational, sustainable business models that is the sort of core theme of this conference. I'm Catherine Howarth. I'm the Chief Executive of ShareAction, an organisation based here in London but working all over the world, mostly with investors, encouraging investors and nudging investors to be really on the front foot in encouraging their own investee companies to embrace change and to think about the long term. And that's a challenge because there's a lot of short-termism in capital markets, and we're going to get into that discussion in a moment. So it's very much my belief that investors have an utterly critical role and responsibility to play in the next sort of vital decade where we really have to decarbonize the global economy at speed. We need to embrace new models and innovate and really think about all of the challenges thrown up by social inequalities and by huge ecological challenges, which are just knocking on the door now of portfolio managers and really making people rethink. So we've got, which I'm delighted about, two seriously sort of significant leaders from the investment community, both of whom, one from a pension fund and one from an asset management firm, have a long track record of embracing quite ambitious thinking in this domain. So we're very privileged to have them. The first is Naeem Abu Jode from Candriam Asset Management, a company that ShareAction has got to know quite well over the last few years and very much enjoy working with. And the other is Magnus Billing, CEO of Electa, Sweden's largest pension fund, also someone who has embraced a very ambitious perspective on these themes of sustainability, responsibility, and embracing long-termism. So thank you both very much. And let's start with a question about you and your sort of personal and professional journey in thinking about sustainability. I wonder if, maybe starting with you, Naeem, and then Magnus, you could sort of share with everyone a little bit about your journey on sustainability, what it means to you professionally and personally.
Thank you, Catherine. I'm really happy to be here today to share with you my experience. Candriam, we started investing in sustainable responsible investment in 1996. And I remember 22 years ago, I remember at that time it was like shouting in the desert. And we were trying to attract people to manage ESG product, and it was a big challenge because they didn't want to go in that field for several reasons. And the reality, maybe to be honest, what was visionary in our side is to keep the investment between 1996 till 2007, because we used to have a team of 15 people with internal analysts, and we were losing money because we were just managing several hundred million of assets. The wake-up call, the big change, the turning point for us as a company was really 2007, 2008, at the financial crisis. And here we saw the change in mentality for big investors and starting to see money pouring in our ESG product. And we moved from 200, 300 million to 15 billion under management, I'm talking in euros, in 2008. And today, Candriam is managing 40 billion euros with an ESG approach, which represents a third of our assets. For me, at my personal level, I have been managing the company as a CEO for 12 years, but in 2007, I was already CEO. The wake-up call for me was two levels. One, the big financial crisis of 2007-8, where we discovered the interdependence between the society, the financial sector, and the real economy, how impactful it was, and the short-termism of all the economic agents. And maybe my son was only 1 year old, and I was thinking, what can I do to play my role and give him a better world and for the future generation? And that was my first son, and I have 3 kids today, and I was really thinking, as a CEO, what can I do and what is my duty to give a better things for them. 2 words about the company. Kandriam is an ESG investor, sustainable responsible investment, but we were one of the pioneers in Europe. The reality, what we want to be today is to be a leader as a corporate company, as a corporate responsible company. By, first of all, as a name, Kandriam stands for conviction and responsibility in asset management. Then in our DNA, responsibility is everywhere. It's how we behave with our people, with our client, with the society. This is one, it's an important one. The second one is how do we act with the people, and what we decided to do is we are taking 10% from all the range that we manage in ESG, 10% of the management fees, and we are putting them in a non-profit organization to invest in social projects and in education as well. And the third one, we are investing a lot in education, and third one is we are investing in kind of project, we call it Kandriam Academy, to continue educating or helping institutional clients to integrate ESG or end clients to understand what is it exactly. There is a lot to be done.
Yeah, thank you. That's a fantastic, interesting answer. Magnus, what's your story?
My story, okay. I come from Stockholm, Sweden. We pride ourselves a little bit in Sweden about being thinking a lot about these questions. We want to contribute to a better world. So that's my sort of the environment I've been living in for, well, more than 50 years now. Time flies. I've been in the industry, this financial and insurance industry, for 20 years. When I started, I would argue that when you talked about environment or ESG issues or corporate social responsibility, it was a cost item on your balance sheet or your P&L. Then you move down the road maybe 10 years. The discussion was maybe not on a cost, but more on a compliance. It was a compliance issue. It was dealt by a support function with legal compliance people. And moving down maybe 5, 6, 7 years, we saw when I was working as the CEO of Nasdaq Nordic Exchanges, a clear customer demand for new products and a clear customer demand for investment opportunities into ESG products. So a shift took place where you move from cost compliance into value creation. It was a clear sign, obviously very slow and early days, but it was a trend that started back in 2008, 2010. And that momentum, that trend has augmented extremely the last few years. And I had the opportunity to be then in a role where I could sort of be part of product development, providing, meeting the customer demands. And I think that was a very important moment for me personally, because I think I saw then that my conclusion was that this is possible to combine a ESG approach with making money. There was actually no conflict in your fiduciary duty as an investor of ensuring good return and integrating ESG factors and providing capital towards ESG investments. And that is, I think we're still struggling with that thing, with the fiduciary duty. I mean, we have a lot of discussions among investors. Is it really in conformity with the fiduciary duty to consider ESG factors? I would argue any day that absolutely it is. And in particular, if you look at insurance companies and pension companies that have a balance sheet with the liability side being extremely long-term. I serve 2.5 million private customers. They expect me to ensure that the company I elect is able and capable to pay out good pension in 30, 40 years down the road. I manage assets to provide that return, to provide that pension to them. And I need to ensure that the matching between the asset side and liability, i.e. the time horizon, the 30, 40 years, is in sync. And that is an absolutely perfect spot to be in if you want to integrate ESG factors. Because then we can talk about risks in the long term, and we can talk about opportunities in the long term. And that's a great fit for the fiduciary duty that I have as CEO of Alecta. Now, I talked about the momentum that came about in 7-8 years ago. That has increased even further. I think there's 3 strong trends in the market space today that forces us to be even better, to improve more and more when it comes to allocating more capital towards ESG investment. One is obviously the regulatory drive that we see in Europe in particular, but also coming in Asia, and hopefully we'll see more of it in the US soon. Secondly, and maybe the most important part, it's the customer demand. When I talk to my customers on the corporate side, 75% of them tell me that you need to consider ESG factors when you invest our money. It's not your money, it's our money, and we want them to be ESG conform, to be ESG promoting. If you look at the private customer side, it's not as high as 75%, which surprised me a little bit, but it's around 70% of the customers telling me that you need to invest in an ESG fashion. It's our money, it's not your money. So that's a clear message, and we hear that message. The third drive, which I think is very important, both in the long term and the short term, is that we invest in 100 companies. We have a portfolio of $90 billion US. 45% of that is allocated to equities, 100 companies across the globe. That means that we become fairly soon a fairly large shareholder in these companies. And we stay in these companies for very many years. If you look at the top 10 companies that we own, we've been on average in these companies for around 40 years. The longest one we entered into 1948. So we're a long-term investor. But what we see in these 100 companies today is that they are very good today in integrating ESG factors into their business model in order to create value. And I would argue that that is a new thing, fairly new thing. And in order for us to be a good investor, to understand the business model and understand how the company is creating value, we need to understand how ESG factors are integrated into a business model. Otherwise, we will not be a good investor. Otherwise, we will not be able to deliver the pension in 30, 40 years down the road. So those 3 drivers is pushing us very strong today in becoming better in integrating ESG factors into our investment process. We're not there yet. We are dealing with issues like culture, data quality. I'm sure we will talk about that going forward. But these are the things that this is my journey, basically.
Thank you, Magnus. It's a very, very sort of coherent picture of all those drivers that are taking us in a very positive direction. Nevertheless, it's a reality that there remain many, many short-termist pressures in capital markets. They're real, they shape behaviors. A lot of portfolio managers are still incentivized in a way that does focus on short-term returns. A lot of clients and institutional clients are checking those returns on a quarterly basis. There's all that pressure that sits there. So in light of that, give us a sort of honest assessment of whether you think, as of today, the investment industry as a whole is doing more to help or hinder investee companies from embracing transformational change on sustainability. And then, having reflected a bit on your perspective on the industry as a whole, maybe talk about what each of you are doing in your own organizations to try and kind of combat that short-termism, because, yeah, it's something that I think needs a very active strategy to undermine.
The industry is still very short-term. According to a study made by McKinsey a year ago, they did a survey with the 250 biggest executives. 60% of them are ready to delay a project in order to hit their short-term result, the quarterly result, on the cost of long-term values. 60%, which means that the financial return is still on the top of the agenda, and we are delaying investment in research and development, most of them, and social, the S, and the environmental issues in order just to manage a short-termist. But the pressure is coming from everywhere. It's coming from the asset owners, from pension funds, from the regulators, and clients at the end of the day. And what is a little bit surprising, if we look at what we call it intangible, which is the patent or brand reputation, it represents in the value of the stocks in the US, in the S&P, 85% of the values. 20 years ago, it was only 25%, which means everything that is extra financial, ESG between brackets, represents 85% of the value of the company. And everyone in this industry is thinking very short term. The good news today is most of the assets are starting to accelerate, and we see this as a company with our 50% growth in terms of ESG assets into the ESG arena. The second good news is 95% of the 250 biggest companies are issuing a CSR report. 20 years ago, it was only 20%. Then it's accelerating. And I think the industry is also feeling that we are living in a world of disruption. Disruption with the governance. 41% of the GDP of the world is managed with populist government. Social inequalities is huge. And the multiplier threat is the climate issue with more than 700 extreme climate events compared to 210 years ago. Then, with all this, there is a collective urgency to act, and all these long-term problems and issues are becoming short-term issues. What do we do as a company? First of all, we try to lead by example. We have been issuing a CSR report without being public or listed since 2003, meaning, I don't know, 15 years ago, we issue a CSR report and we try to apply, to practice what we preach with our investors and with the company we invest in. Second, we are lucky to have a parent company which is a mutual company like yours. It's a life insurance called New York Life, and they have been around for 170 years, and they think very long term, and we think very long term with the partnership we have with our clients. We are not a financial investor, we are trying to think very long term, and that's why what we do with the holding, when we invest in a company, we try to keep it as much as we can, and our turnover is half of the turnover of the industry. And we are also very active owners of the asset of our client, meaning we engage with all the company we invest in. 100% of the companies that are in our portfolio, we have a regular dialogue with the companies, and we do them on our own as a company, as an asset manager, managing 150 billion, which is not very important with all the problems you have to deal with, but we do it with share action, with collective initiative, and we are part of 40 big collective initiatives and trying to engage and to have a direct impact on companies.
Wonderful. Magnus, let's hear your thoughts on short-termism more broadly in the sector, and then what you're doing at Electa to keep that pressure at bay. Right.
Well, I think we talk a lot about short-term and long-term, and it's very binary when we discuss it. And I think we, in my mind, we need to acknowledge that we need short-termists to some extent. I think for us as a long-term investor, we like the short-term capital when and if we enter or exit an investment, obviously, because it creates liquidity. It's one of the key features of any marketplace to have that price formation. So there's a value there. So we shouldn't just throw it out without proper consideration. I'm not that concerned about if you look at our equity portfolio, the companies that we hold, I think they are thinking long-term, but obviously, something happens. If you go to our beneficiaries, it's their money. They're investing their money for their retirement, so they have a long time horizon. But then when you move down the investment chain, down to the equity side, for example, something is happening with the capital. It's becoming less long-term. It's becoming short-term in a sense. And it's very much, I would argue, driven by the intermediaries in the financial industry, unfortunately. And there's Professor Kay has pointed out this in reports and so forth, so it's well established. And I think that investment chains is something we need to address, because it's clearly not in line with the beneficiary and his or her view of how his or her money should be used. So we are not fulfilling our duty and duty of care towards the beneficiaries fully here. And how do you then go about to do that? I think, obviously, looking at the lecture, we need we have a culture aspect in our organization that we need to address. We need to look at the incentive schemes, and we're working with that to sort of pay out remuneration for more long-term achievement of goals. I think we need to get better at talking with the investment opportunities that we have, talking about the right issues. We need to understand, we need to have a wider risk definition, i.e. we need to understand the data, the long-term data, to understand the wider concept of risk in order to incentivize more long-term. We need to understand the transition that's happening in society better. And that's a long-term aspect, and that requires us to be more knowledgeable and more capable of asking the right questions to the investment opportunities. So that's education, that's training our employees and so forth. But what I think is extremely important for an investor of a pension company or insurance company is the supply side right now. Because the society needs to transform, and I had the opportunity to be one of the members of the high-level expert group that the European Commission appointed to look at how can we incentivize mainstream capital towards more sustainable investments, and what are the hurdles. And it was clear that the policy goals are clear and set. We know the Paris Agreement, we have the SDG agenda and so forth. But if you go down to the specific member states of the European Union and you look at the plans to take us to the goals, there's a lot of work to be done. And that has enormous impact on us as an investor, because we would be the perfect investor to invest into infrastructure needed to transform the societies into a more sustainable society. But the supply side is not there. And I think that is a short-term aspect. I think the policymakers and the political system is too short-term in its functioning to actually provide the transitional vehicles that we need in order to make the society more sustainable. Money is there, the interest from the pension companies and insurance companies is there, but the supply side is there. So I think I'm more concerned about that short-term side than on the corporate side, actually.
Very interesting. I think there is a more and more of a, I mean, it's fantastic that you have that experience on the high-level expert group, and I'd like to come on to the role that Europe is playing in the world in a moment. But I do think that, of course, there's short-termism in the corporate sector and in the investment sector, but actually there's some long-term thinking too, and it's very right that the investment community and the corporate community challenge the political community to think long-term. So I think there's a really important role on that. Let's just turn to this sort of relationship between investors and companies. Because it does seem to me that whilst it's absolutely right that investors that hold equity holdings in different companies should be robust in challenging companies from time to time, but they also need to be partners. And really to enable companies to be bold, innovative, transformational. I'd like you each to reflect on how you're improving the conversation, both with investee companies, but also with other stakeholders. Maybe particularly, Magnus, you might talk about how you're having a conversation with the beneficiaries, millions of them in Sweden, that, as you say, can provide a lot of energy and create a mandate for ambition on ESG. Maybe you could start, and then you could talk about those company-investor relationships.
Sure, yeah. It is a challenge for us because, I mean, as you don't go around thinking about your retirement and your pension. So it's a low interest product, and it's not a consumer product. So we have a challenge to get in touch with our customers. There's maybe a handful of events in life when you're actually interested in reaching out to us, to be frank. It's when you retire, obviously, but when you change employer, when you become sick, and so forth. So there are a few times. So we try to capture those moments in life where we can actually have a dialogue with our customers. So that's one thing. And then, obviously, the technology development is supporting us to understand when they would be sort of open to have a dialogue with us. But setting that challenge aside, we feel that we have an obligation to make an interpretation of what is the beneficiary's interest. You can go about to do that in many different ways, obviously. You can do research on sort of the society in generally, you can study research and so forth. And so I think it's wrong for a pension company, insurance company to say that, okay, we don't have the regular daily contact with the customers, therefore we will not sort of take a position on ESG. I think you need to do more than that, and you can do more than that. Now, looking at, you talk about short-termism and long-termism on the corporate side, and how can we go about to stimulate that dialogue? We did last year, for the first time, a stress test of our entire portfolio based on 3 climate scenarios. So we assumed the price on carbon price 20, 25 years down the road, discounted that, and we got a market value for each holding that we have in our portfolio. Equity, fixed income, real estate. Obviously, the result is that the market value that we got out from discounting the carbon emission was lower than what the market price is showing currently today. So that discrepancy, that difference, then is a fantastic basis for us to reach out as part of our engagement with our companies, for example, and ask them the question, look, we've done this calculation. We come to the conclusion that the value of your company is lower than what the market is showing today. Do you agree with our calculations? Do you agree with our assumptions? Yes or no? Okay, if you agree with that, what's your plan? What's your plan? Is it a cost case for you, or is it an adaptation of the business model? Please explain to us. And then, based on the information we get, we can take a decision whether we want to invest more, if we want to invest less, if we want to engage and sort of try to change the view of the management and the board of this corporate. So that's one way for us to actually get in concrete Excel discussions with the corporate about climate aspects and how we impact the business model. Now, having said that, obviously, when we talk about Scope 3 data, the quality is very poor. So it's a blunt instrument, but it has a very strong dynamic, I would argue.
Fascinating. Well, maybe later, well, I want to leave plenty of room for questions, but maybe somebody could ask him what they've done with all the companies that didn't come up top trumps in the stress test. But Naim, to tell us about the conversation and how it's changing between you as an investor and the portfolio companies that you have chosen.
Maybe just to come back on the question, how we have to engage, I think it's a collective and the whole value chain has to work together. There is a shortfall of 30 trillion if you want to apply the SDG, the 17 SDG, 30 trillion. A lot of money. Then we need to channel the financial sector to the real economy. And here we need first the regulators. The high expert group made an excellent job in 2 years' time. It's the first time that Europe is accelerating like this. It's great, but it's not enough. Public entities and cities are also evolving. 65% are willing to be CO2, reducing the CO2 emission. Corporate are starting to move forward. We saw Shell this morning, but Adidas is evolving in the right direction. Evian is going to be completely recycling plastic, etc. Asset owners, they have to play a bigger role and put a bigger pressure on us, on an asset manager, because at the end of the day, pension fund and insurance company, they own the money. And they always say we think long term, but they put the pressure on the asset manager on a very short term. Then at the end of the day, it's always tough, but they are moving forward. 75% of them are integrating the ESG factor and trying to reduce the CO2 emission in Europe, which is great. And asset manager, we have to be better, include the ESG factor and do a better reporting, in fact, with the extra financial to our asset owners. And in fact, it's the whole value chain. There is an urgency here. And even if all the value chain is moving fast, I'm not sure that we are going to be ready. I'm a little bit worried because today I feel the last 2 years it's an exponential growth, but it's not yet there. We are talking a lot about long-termism, about SDG, about things. The good news is we know we have a platform, we have a benchmark SDG, better harmonization, taxonomy. But the reality when I speak with the end clients, we have 40% of our clients who are private and retail. They don't care about SDG. Most of them, they say at the end of the day, it's like the Gilets jaunes in France. You talk about the end of the world, we want to talk about the end of the month. Then, and what is SDG for us and what is sustainable? Well, we don't care. What we want is we need a level of purchasing power. We have a big part of the population who is not inclusive yet in it. And the big issue is how we bring everyone aligned with one objective. We are starting to move, but a lot to be done. Yeah.
Absolutely. Well, look, that brings me to one final question I wanted to ask Magnus, and then we're going to open up. There's a bunch of really great questions that have popped up on the screen. Magnus, you've talked a number of times about fiduciary duty, a topic that ShareAction's worked on for many, many, many years. And ultimately, it's about having the best interests of a certain group of people who, as you say, may not be that directly engaged in the conversation, but as a fiduciary, you have to take a value judgment about what is in their best interests. And clearly, in the context of a pension fund, it's in their best interest to secure them a nice income in retirement. At the same time, you said in your FT-FM interview, very useful background reading, that there's no pensions on a dead planet, which I think is a very powerful statement. Ultimately, we're kind of reaching this point where I feel that a really kind of enlightened interpretation of fiduciary duty means embracing not just the maximization of even long-term returns, but actually managing some of the potentially catastrophic implications of climate change on the quality of life of people and their spending power in retirement and so on. So can you tell us a bit more about how a pension fund like yours, which I would say is in the vanguard of thinking globally about what it means to act in the best interests of beneficiaries, how you see your responsibility to kind of address the impacts and the realities of a sort of catastrophic climate change alongside that obligation to secure financial returns? How do you see those blending together in the future?
Yeah, that's a very good question. To me, they go hand in hand. There's no conflict. There's no friction. It's just a matter of what kind of time horizon you take. And I think the things you're mentioning they are risks. And we are to deliver a risk-adjusted return to our beneficiaries. What we haven't done properly in the past years is to consider those risks. We've had a too narrow risk definition. So what we're trying to do is widen that to capture these things, which in my mind will lead to the conclusion that we will sort of not only look at the short-term financial return, but what kind of environment will you be able to spend your retirement in 30, 40 years down the road. That's how I look upon it, and that's where we want to. That's the position we want to get to. The same thing on the opportunity side. If you look at the investment possibilities that we have, how sustainable is their business model in 30, 40 years down the road? What is the opportunity here? If we can see that it will not be in compliance with the Paris Agreement, this business model, obviously we don't want to be invested in that company. We may want to be invested here and now, but we want to see a clear plan to transition into a more sustainable business model. And I think that is one of the concerns I have and the challenges we have internally, because I don't want my portfolio managers to be too defensive. I want them also to embrace transition. So if we can properly engage, and require a strict plan and timelines and investments on the transition, we are prepared to be there as an investor, as an owner. And I think it would be foolish of us, or the society in general, if we push too far away from embracing transition. And that is one of the concerns I have with the European Commission's taxonomy right now, focusing only on green. I don't know if you answered the question, but...
No, okay, great. Look, let's take some questions. So, this is a nice one. Do responsible companies make more profit? Does responsible investment give better results for the investor?
So,
by the way, we're short of time, so you need to do 30-second answers to these next few questions so we can get through a few of them. Okay.
So mathematical, when you start to take out the companies that are not so sustainable, you will get the investment universe will decrease, so you will have a less expected return, right? You will have a higher volatility. So that's mathematical. The data shows that.
Yeah.
So what you need to add on is where do you allocate the capital then? And then you need to find the companies that have good governance, have a strong long-term business model, and then you can increase the expected return with the lower volatility. That's pure modern portfolio theory. But the starting point, and I think that's why this question is coming up, yes, you will have a lower return by exclusion. But what do you do with the money that becomes available when you exclude? That's the trick. And that's what, if you can do that properly, I can argue that no, you will not say no to return just by being a responsible investor. On the contrary, a good company with good governance and focus on the long term will probably have a better return going forward.
Naeem, does it pay to be responsible?
In 30 seconds, the answer is yes. There is a lot of academic study about that, and when you think long term and you invest long term, usually you have a better perspective and the results are better, and you improve your risk reward. At least you diminish the volatility of your portfolio.
Okay, I'm gonna do one more. Many businesses' current valuation is a result of environmental degradation. How do we get ESG better accounted for and companies accountable for their legacy? Ooh, these are big philosophical questions, brilliant questions.
Tough one.
Yeah. Who wants to take that one first? No.
I'm trying to read the question.
Oh, you're trying to read it?
Do we get ESG?
I know, they keep flicking round, so that's quite...
So what we would love to see from the corporate side is to talk about the turnover line from an accounting point of view. Which part of the turnover is sustainable and which part is sort of more towards stranded assets? And we are getting to a point where we can be fairly good in dissecting the turnover line from that point of view. And if we then add on the engagement with corporate about this, our experience is that we can have a very good discussion, and hopefully the corporates also feel that we're adding value by having this discussion. But that's maybe not on the accounting side, but at least dissecting the turnover side so we can talk about sustainable or non-sustainable earnings capacity.
Yeah.
My opinion is we cannot improve and think only financial. At the end of the day, we have to give back part of what we are doing. I give an example. As a company, what we do, we offset all the CO2 emission of Candriam. We are completely carbon neutral. We have been growing by 50% the last 5 years while diminishing the CO2 emission. Every economic agent will have to do it and take care about the global planet and the resources we have. Then the answer is, I would say, yes. They have to pay back in a way or another.
Brilliant. Well, look, I'm gonna conclude there. But I hope that these gentlemen are around for a little bit more of the day. So if you've got questions that there were more questions, please come and find them. Come and find me. I'm also around for the rest of the day. I hope this has given you a sense of some of the really far-sighted and quite enlightened thinking that's present in the capital market system. It's not a perfect system at all. It's still responsible for sending some quite dangerous signals down into the corporate community, both in the way that, the conversations that take place, which drive short-termism in the company sector and in capital allocation, not yet really being aligned with where we need to go. But there's real transformation taking place in the investment community. And if we can get that right, I do think it opens the door. It really enables companies to be bold, visionary, to create the change in the real economy, as you say, Naeem, that all of us, as citizens, as pension savers, as employees, we will need that. And I think the investment community is, bit by bit, stepping up to play a really transformational role in the world. So great. Thank you so much, both of you, for sharing your insights and your stories.
Thank you very much. Thank you.